Hi, I'm Michael Landsberg, Chief Investment Officer of Landsberg Bennett Private Wealth Management. Welcome to our first market update for 2024. Can't say that I'm disappointed that 2023 is over, given the fact that we had a lot of market unrest as well as some global unrest. So a lot of what happened in 2023, I don't think it's going to continue into 2024. The Federal Reserve raised rates aggressively in 2023, and we think that's over. Realistically, right now, we think the Fed will be in a pause mode for the next 6 months, but the next moves we think will be to lower interest rates. So that'll actually be at some point a positive, given the fact that rates are pretty high at this point. Inflation has also started to come down. Still higher than it needs to be for the Fed to probably lower rates, but inflation now has gotten back to more of a realistic environment, whereas before it was almost, in 1970s type environment, 9% type things. So those are positive backdrops we think for 2024, and given kind of where we are. We do think we're in a slow growth environment. We think we're going to see GDP get to around zero. I think it'll be slightly positive for the fourth quarter, slightly negative for the first quarter, but realistically, nothing really awful at this point. What happens in a slow growth environment is when you find companies that are growing, you got to pay more for. And so we're looking for those areas of the market that we think will continue to do well, given kind of everyone else is kind of slowed, and you're going to still find those companies in sectors and themes that we think are going to do well. A couple of the themes that we continue to emphasize in basically all the portfolios are, first would be AI. Now, artificial intelligence has been around for a while, but generative AI, which is a smarter AI, is a newer thing. 2023 was a year when anybody who said they had AI, their stocks went up. 2024 is going to be a year where it's time to kind of put your money where your mouth is. Are you making any money from AI? You can't just say it anymore. You have to actually have some earnings to go with it. We think we've identified a lot of those companies. There's more companies that say they're in AI than there actually are. And the companies that we think are real players in the AI space will continue to do well. And those are across most of the portfolios. Second one would be cybersecurity. With anything new in technology, you're going to have more security around it. One of the advertisements that's out right now talks about AI being the Wild West. Who's the sheriff? Well, interestingly enough, I think you're going to need more and more sheriffs. Historically, we had a lot of identity theft anyway. You know that just because you get hacked and people try to hack you now. Now with AI, things being smarter, we think we're going to need more and more cybersecurity. That's a theme that we own, again, across all the major portfolios, whether it be dividends, growth, small, mid, international, and even our next gen portfolio. You want to have cybersecurity basically across the board. It's going to be a winner. And the last major theme is obesity. I've talked about it for a while. You're looking at, kind of a revolution in drugs, and some of the new drugs that have come out have really been able to help people, lower their weight, lower their sugar levels, which ultimately may lead to longer lives. A lot of those drugs have been very helpful in terms of lowering cardiac risk profile, liver function, improving liver function. So there's a lot of positives that are going there. We want to play that multiple ways as well. So we're always looking, again, at the kind of the major players in this space, but also what's going to happen for the next few years. So those are kind of our major themes. The sectors that we like, again, we're still favorable to technology because of that. We like healthcare. We think there's growth there. A flip for us from last year to this year is we like utilities again. Utilities don't do well when interest rates are going up. Specifically, obviously, because the cost of capital goes higher. With rates now at least going to stay the same and start to trend lower, we think utilities offer us an attractive place to start to put money back to work, and we did that actually in our rebalance. We're seeing some more utility exposure. Again, the yields are fine, but realistically now with rates going lower, we think we're going to get some growth out of there after a lousy 2023. Part of it is to kind of skate where the puck's going to be as opposed to staying where it is. 2023 was a great year for tech. It was a lousy year for utilities, so we want to add some utilities. Most people forget that tech doesn't make money every year. 2022 was an awful year for tech, And thankfully, we didn't have as much tech as we had in 21. We lowered it in 22. We added some back in 2023. You'll probably see us trim a little bit of the tech exposure in 24. Not because we don't like it, but anything that does really, really well has a tendency to kind of revert to the mean. So we want to be looking at that from a risk standpoint. One of the other themes that we think is going to happen, we think gold will continue to do well this year. Slow growth environments are typically, and with inflation going down, that's typically a great time to own gold. Most people think that, oh, you want to own gold to outpace inflation. If that was the case, gold would have made a lot of money in 21 when inflation started really to pick up. It didn't. It lost money. Gold actually does better in a deflation or disinflationary environment. Disinflation means growth, inflation growth going slower, which is where we are now. And again, with growth being less abundant, you're going to want to own something that's going to be able to hang in there. So we still have a good allocation to gold. We've added gold miners as well from a satellite standpoint to give us some exposure to some of the things that we think are going to continue to do well. Thematically across the world, I mentioned those big three themes. We continue to like that. But there's other things in the world, given what's happened, that make a lot of sense for us to own. So for example, we've owned as a satellite an ETF that owns some alternative energy. In particular, it's uranium and nuclear. And why would you own such a thing? Well, the war in the Ukraine has a huge amount of resources, and those resources aren't getting to the rest of the world. Russia also has a lot of those resources, and those resources are certainly not getting to the US. So there's going to be scarcity in that space. Anytime there's scarcity, prices go up. And so we want to be on the side of where we own some of those companies that are engaged in mining in it and actually the material themselves. So there's some areas there that we continue to like and look for outside of the normal scope. India has been a big exposure for us for about a year. We continue to think India is a great spot for us to have some money that's our outside of the US money. The reason's pretty simple. They're growing much faster than the rest of the world, growing even faster than China, which China makes up their numbers, and India's still growing faster than the made up numbers in China. But also the Indian government is a government that's not raising rates, where that's been very difficult. And bluntly, the Indian capital markets are very similar to the United States. Their companies are in the business of trying to make money. I don't really know what the Chinese government's idea is, but they're certainly not capitalists. And so we want to avoid those markets. So you'll see us, for example, over the next few months, add some names, for example, that are anti-China, more pro-India, given the fact that India's educated population and growth is going to continue to be there. So that's an area that we continue to like for again, our satellite exposure or things that are not in the US. Because again, it's important to look, when we look at the US, is the pockets that will do well, again, we mentioned those, but also areas of the world that we think are going to continue to do well in addition to the US. The interest rate environment, we think rates have, for the most part, topped out here. So you're going to see our bond exposure. We're going to start, instead of being just as much in cash where we're getting the returns, is you may see some exposure to medium, intermediate, and even some longer-term treasuries and corporate bonds, just because as rates go lower, we're going to look a year from now and say, I wish we had locked some money in. So that's what we're in the process of doing, making sure that we've got some money kind of locked into some of these rates while they're higher, because even though we don't expect the Federal Reserve to lower rates right away, the bond market may take rates lower, and we're going to want to have some money that's going to be up in this 4 or 5% area, because that's a good return for bonds. For years and years, we're used to getting basically 0% in cash, and now we've gotten a good return in cash. But we think we want to make sure that we've got some of that cash headed to the intermediate term bonds to lock in some of those returns. What'll happen is, and typically when bond prices and bond yields get higher, it's competition for stocks. And so when rates are going to come down, that may be a little bit of a tailwind for stocks. But again, at the end of the day, when you're looking at some of the stocks that we own, if they're paying a 1 or 2% dividend, and we expect them to grow much more than that, the money market or the bond yield shouldn't really affect that. You own bonds as a cushion against stock prices and volatility. That's the reason we own that. It's the other reason we added to gold. Gold has a tendency to zig and zag differently than stocks and bonds, and that really, at the end of the day, is what we try to do for clients. We're in the risk management business first. So a lot of times it's not about always trying to make the most amount of money in any given month or week or quarter. It's about over a 5 or 10 year cycle. Are we in a position to do the best we can do without having huge swings downward? Because as you know, when you lose money, you have to make a lot more to get back to even. So if the market loses 20%, you got to make 25% to get back to even. If it loses 25, you got to make 33%. And God forbid you lost 33% of your money, you got to make 50% to get back. So one of the keys with that is just don't have the big losses and the big volatility. And we did that in 2022. We had a lot less volatility than the market. That hurt us a little bit in returns in the first, let's say, 7-8 months of 2023. The last quarter, the last 90 days of 2023 were very strong for us as we've moved more to the positioning that we're in now, which is this 2024, where the Fed's going to be done raising rates, and we think that's an opportunity for us in selected parts of the U.S. economy to do well. We still don't like parts of the United States real estate market. We think there's commercial buildings and things in cities that are empty. We think some banks made bad loans there. So you're going to see us still avoid, parts of the U.S. market. It's not, a panacea where everything's great, but the parts that we want to avoid, we're going to avoid. And in fact, in the past, we've had some positions where we even shorted parts of those markets because we worried about, basically this commercial real estate market with lower rates that are now high. That can be a problem. We think it's still possible it can be a problem in 24. But the parts of the market, the healthcare, utilities, and technology that we like, we continue to think that's going to be a good spot for us to be. With that backdrop, again, we think we're going to have a little bit less volatility in 24 than we had in 23. That obviously, my crystal ball doesn't tell me what's going to happen geopolitically. Obviously, what's going on in Israel, that can change. Recently we had some issues with the oil market, where a bunch of yahoos were doing some stuff that pushed the price of oil higher. We can't ever look to predict those, but fundamentally, we think the price of oil should go lower as the world's slowing growth. That should actually put pressure on inflation that can kind of continue to come down. So those are some positive backdrops that we have, again, for the companies that can deliver good products and good growth. We think they're going to do well. 2023, what happened was we had a very few amount of stocks that drove performance for everything. Now, the good news is we own 6 of those major 7, or the Magnificent 7. But the idea with those stocks is it's going to have to broaden out. And so as things broaden out, that's going to be healthier for the market to continue to go higher. That should mean less volatility. Because honestly, if those 6 or 7 stocks didn't go up, the market went down. We still have 30, I think it's almost 40% of the stocks in the S&P 500 were down 25% or more in 2023. So if you look at the headlines, the market was up in 2023. That must be great. A lot of stocks didn't do well in 2023. And so we're looking through that, kind of sifting through that rubble to find some names that we think are still attractive to be able to purchase, to be able to take advantage of that. Because not everything was up what the S&P 500 was up. In fact, again, it was really focused in that small group of names. We think those names, most of those names will continue to do well. But again, after you have a year where you're up 100 or 200% in a handful of stocks, those are the names that we're going to look probably to trim to make sure that we've got a proper allocation for you going forward. So the takeaway is we think 2024 should be a better environment, given the Fed's going to be kind of on hold to potentially lowering rates. Inflation has been falling. That's a positive for a lot of the companies that are out there. The curveball, of course, it's an election year, and who knows what's going to go on with this election. I mean, it's probably one of the crazier elections that we're going to see in terms of the personalities that are involved. But at the end of the day, we're investing in fundamental companies and businesses that are doing well. So regardless of what happens, you're going to start to hear rhetoric, I'm sure, around healthcare and insurance companies making too much money. At the end of the day, that's just the noise. Fundamentally, those businesses are very sound, and so if we see any price drops, in particular in those sectors, we're going to be looking to add to those. Because that's basically the game plan we've had for the last 20 years in elections, is politicians on both sides chat about certain sectors they don't like because they make a lot of money, whether it's healthcare or tech. Those sectors maybe get beaten up a little bit temporarily. It offers us good entry points. Because at the end of the day, we're not really buying these companies for the next month or quarter. Ideally, our strategy is to buy some of these, be able to hold them for 3, 5, 7 years, and really be able to appreciate it over a full cycle. Cycles aren't year to date, cycles are cycle to date. So even though a lot of times we look at things on a year to date basis, we'll want to look at cycles and say, okay, this is a growth cycle, where are we? We think the cycle that we're in started really November of 21, where the market's kind of peaked. They've fallen, they've gotten back up. But in fact, other than the S&P 500, the NASDAQ market and the small cap market are still not back to where they were a little over 2 years ago. So we're not yet to this new cycle, but we think we're getting closer and closer. So with that, I'm going to end. Again, we appreciate the confidence and trust you show in our team. Again, hopefully you had a good new year, and we look forward to being able to see you, whether it's in person or video, in the coming quarters. Thanks again, and goodbye.